Welcome back to Alpha Recap, your after-hours market rundown from stockalpha.ai. Today, we're breaking down a session that finished with a clear risk-on tone, but with some important caveats. As always, if you have questions, you can reach us at stockalpha.ai.
Good to be here. The headline was simple. Markets closed up, led by big tech, energy, and a crypto-related rally, but the internals were anything but broad. Think concentrated leadership rather than a market-wide charge.
Exactly. The S&P 500 outperformed overall, and the Nasdaq 100 actually led the pack because investors piled into large technology and AI-adjacent names. Meanwhile, the Russell 2000 lagged. Small caps just didn't participate.
That pattern keeps showing up this quarter. The big liquid names catch headline-driven flows and momentum, while smaller names sit it out or get hammered by policy-sensitive headlines, cannabis being a prime example today.
I want to stick on that cannabis point for a second. The sector slipped after fresh policy headwinds were flagged in late January coverage. And because those stocks react so strongly to political or regulatory signals, you saw a pretty quick unwind.
Right. Those names are essentially trading on probability of regulatory change. So when headlines point the wrong way, you get big moves, even if fundamentals didn't change. That increases volatility for anyone holding sizable positions.
So, what moved the tape today beyond cannabis? We had a mix of micro headlines, a renewables breakthrough, an oil and gas asset deal rumor for one major producer, and some drug chart momentum that sent a big pharmaceutical name higher.
Exactly. And don't forget crypto. A renewed rally in cryptocurrencies and optimism around tokenization, the idea of representing real world assets on blockchains, pushed related equities and thematic ETFs higher. That narrative leaked into fintechs, exchanges, and custody plays.
Tokenization, explained simply, it's taking something like a bond or a piece of real estate and creating a digital token that represents it on a blockchain. The pitch is faster settlement, more liquidity, and easier fractional ownership. When the crypto market rallied, stocks tied to that narrative benefited.
Good plain language explanation. But remember, tokenization is still more narrative than proven, so those equity moves can be especially headline sensitive. If crypto retraces, those names often give back gains quickly.
Let's walk through sectors. Tech and communications led the risk on charge, with software, AI infrastructure, and streaming related names getting the most love. Streaming interest kept one big streaming service among the winners. Searches spiked, and that alone can move sentiment.
And in energy, we saw a real split. Traditional oil and gas names rallied on deal chatter. Reports that one oil major was finalizing a Singapore asset transaction helped, while renewables benefited from a separate breakthrough report. So the energy group wasn't uniform, it was bifurcated.
Defense and industrials also did well. Aerospace and defense exposure rallied after a strong read on one major defense contractor's positioning. And M&A talk in materials and mining gave miners a lift.
On financials, it was mixed. Big bank commentary about credit card trends caused intrabank dispersion. When a CEO talks about card dynamics, traders parse implications for net interest income and charge-offs, and banks trade differently off that.
Real estate was muted to softer because deal and loan headlines tend to reprice risk for leveraged property owners and mortgage lenders. Utilities were range-bound. A few grid modernization winners outperformed, but the group overall didn't move much.
A couple of individual names stood out. The defense contractor we mentioned outperformed as investors debated defense allocations. A big pharma company rallied after a Darzalex-related update. That chart move was about 26.6% in a specific oncology context, and quant flows followed.
Chevron rallied on reports it was nearing finalization of a Singapore asset deal. The market liked the prospect of strategic pruning, possible capital returns, or redeployment into higher return projects.
Meanwhile, Kraft Heinz got hit because a major investor was reported to be preparing to exit about 28% of its stake. Large shareholder exits like that create short-term liquidity imbalances and pressure food and beverage peers.
And in the crypto-exposed universe, exchanges, custody platforms, and certain fintech names outperformed as tokenization narratives gained traction. That tied back into the broad risk-on tone, even if it was concentrated.
So when we say the rally was concentrated, what do we mean? Technically, indices moved higher, but breadth was thin. A small number of mega cap leaders carried the indices. That's the divergence between cap-weighted and equal-weighted performance technicians warn about.
Exactly. A handful of names pushing the averages higher can keep momentum for a while, but it also makes the market vulnerable to a snapback if news changes. Momentum can extend, but it can reverse fast.
From a fundamental view, the tape today was really driven by company-specific catalysts, asset deals, drug chart updates, and policy headlines. Those are healthy when they reflect real earnings improvement, but dangerous when it's just momentum chasing headlines.
Let's talk Fed and macro. There weren't any surprise macro prints to change the Fed outlook materially. Inflation has been sticky but improving, and labor remains resilient, so the Fed stayed in a data-dependent stance.
Two implications for positioning emerged. One, rate path uncertainty remains. The market is cautious about pricing aggressive rate cuts because inflation hasn't decisively fallen. Two, in the absence of big data, policy expectations are getting shaped by corporate news and slower macro signals.
Put simply, earnings calls and corporate guidance are suddenly more important because they give traders info about demand, pricing, and margins. The same inputs the Fed watches. So if companies talk about easing input costs or weaker demand, it can change expectations for rates.
For traders and portfolio managers, that means staying nimble. If inflation accelerates or employment sharply deteriorates, risk assets would be repriced quickly. But until then, the market can run on narratives and company catalysts.
A listener-friendly tip. When leadership is narrow, diversify. If your portfolio is concentrated in a few winners, you're more exposed to headline risk. Balanced exposure and focus on fundamentals, like earnings power and free cash flow, help manage that.
Agreed. Now, quick reactions. What surprised you most about the session?
Honestly, how quickly crypto narratives spilled into equities. Tokenization is still early, but the flow into custody and exchange stocks was meaningful. It shows how sentiment in one corner of the market can contaminate others.
I was struck by the Kraft Heinz dynamic. When a large shareholder takes action, it can create a chain reaction across an entire sector, even if nothing else changed operationally. That's a liquidity story more than a fundamental story.
Let's cover what to watch next. First up, company earnings and guidance. Any commentary about inflation, margins, or capital allocation will be parsed for Fed-relevant signals.
Second, crypto and tokenization follow through. If cryptocurrencies keep climbing or regulators offer clarity, crypto linked equities could get another leg up. If crypto retraces, expect those names to fall back fast.
Third, cannabis policy headlines. That sector is extremely sensitive to legislative news. A single comment at state or federal level can reaccelerate either selling or buying.
Fourth, watch banks for credit card commentary and regional bank prints. The CEO remarks earlier caused intra-bank dispersion. Traders will want confirmation from actual credit metrics.
And finally, macro data points and Fed speak. Even in a headline-driven market, inflation and employment releases still matter a lot for the medium-term path of rates and liquidity.
Before we go, a quick primer. What does concentrated leadership mean for an everyday investor? It means your index ETF might look good because a few megacaps are soaring, but your own diversified holdings might not be participating. So check equal weight performance and your sector exposures.
Also check valuation and free cash flow conversion. If a name is rallying on a headline but not improving cash generation, that's a red flag for longer-term investors.
One more practical point, manage position sizing. When volatility is elevated and leadership is narrow, having smaller sizes in speculative names and larger sizes in diversified cash-generating businesses reduces tail risk.
All right, let's sum it up. Markets closed up with a risk-on tilt, led by big tech, energy, and some crypto-related plays. But breadth was thin, small caps lagged, and policy-sensitive sectors like cannabis and parts of consumer staples were sources of weakness.
The drivers were a mix of micro headlines and narrative flows, renewables breakthroughs, corporate asset deals, drug chart moves, and crypto tokenization. That made the session story-driven rather than macro-driven.
Technically, the rally showed concentration. Cap-weighted indexes outpaced equal-weighted ones, which keeps the door open for quick reversals if headlines flip. Fundamentally, investors should focus on durable earnings and cash flow versus transient momentum.
In short, short-term, momentum favored risk-on. Medium-term, the Fed's data dependence and headline sensitivity mean volatility will likely stay elevated. Respect the moves, but size positions appropriately.
Thanks for listening. If anything we covered today piqued your curiosity or you want deeper data, head to stockalpha.ai. If you have questions about anything we covered today, go to stockalpha.ai where you can ask us directly through the Q&A feature and we'll answer live.
For more market analysis and to submit your questions for our next episode, visit stockalpha.ai. We'll see you next time on Alpha Recap.